Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, listener, and thank you for joining us today. We released our Q2 Global Market Outlook last week, titled More Conviction. This is the second episode of a 5-part mini-series which we kicked off on Friday. Today, I have with me Rajat Bhattacharya to give us his thoughts on the evolving economic landscape. We will discuss things such as the risk of global stagflation, why China might bail us out a little bit, and what are the key things investors should be focused on with regards to their radar. Okay, so Rajat, let's get straight into it. Market moves since the start of the year, stocks and bonds are both down year to date, suggests investors are pricing in higher risk of stagflation. So how serious is this risk?
Yes, Steve, this is indeed a key risk to the macroeconomic outlook. Let's get our definitions right first. So technically, stagflation is defined by slowing economic growth and rising inflation, but accompanied by high or rising unemployment. It's a rare phenomenon last seen in the developed markets, especially in the US in the 1970s, if you recall. The Fed was then forced to raise interest rates sharply to bring inflation back down to its sustainable levels. Typically, equities and bonds both suffer negative returns during stagflationary periods. Hence, this year's market moves have understandably caused some concerns. So, going back to your question, Steve, the sharp fall in growth expectations and rise in inflation estimates in the US and Europe in the past month means conditions in the two economies partially, I repeat the word partially, meet the definition of stagflation. The backdrop of US inflation at 40-year highs, even before the Ukraine conflict flared up, adds to that risk.
Okay, so you say partially. So what am I missing?
There's a key factor missing, Steve, in all of this noise, and that is the job markets are strong both in the US and Europe. In the US, jobless rate is below Fed's 4% neutral rate for unemployment, and in the euro area, it's at its lowest since records began in 1998. Strong job markets are enabling central banks to turn their focus towards taming inflation. We believe stagflation risk can be contained as long as job markets hold up and monetary policies remain accommodative over the coming months. Indeed, we are likely, like the broader market, of course, expects above trend growth in both the US and euro area this year, as plentiful jobs and rising wages support consumption. Households in both the US and Europe have built up significant savings during the pandemic, as we know, which are likely to be deployed for services consumption as their economies open up. So in Europe, the Ukraine conflict has added benefit. So that is acceleration in plans to boost spending into defense and energy infrastructure, which could support growth. Meanwhile, the Fed's revised projections means its policy rate will be around 2% by the end of the year, and that is really still accommodative given the Fed's own estimate of 2.4% neutral rate for the long term. So, given that the Fed is likely to and the Fed might even turn less hawkish if the job market weakens. For the euro area, we expect the ECB's benchmark deposit rate to stay negative at the end of the year, even if it ends asset purchases and starts raising rates in Q3. Our positive outlook for consumption, fiscal spending in Europe, and policy rates leave us constructive, really, on the economic outlook for the world's two biggest economic blocs.
Okay, so that's Europe and the US. Let's move on to China. So do you see, a lot of people have become very bearish on China recently. So do you see China as adding to this risk?
Actually, conversely, China's economy is in fact on a divergent path from the US and Europe. China's consumer inflation remains well below the central bank's 3% target, while growth is stabilizing around 5%. So low consumer inflation is allowing policymakers to implement a range of targeted policy measures, as we've seen in recent months, from easing credit growth to infrastructure spending. And the aim is to meet an ambitious 5.5% growth target for 2022. So recent statements from Vice Premier Liu He and several regulators pledging coordinated action to support financial markets and economic sentiment are pointing to further measures in the near term. A revival in economic activity in China, albeit much restrained compared to with the past, is likely to act as a stabilizer for global growth in the coming months.
Okay, so I guess a lot has changed so far this year. So what should we look out for going forward?
So, see, this is the key question, right? So, when we published our 2022 outlook, if you remember, in December, we flagged two main risks, and one was the oil prices, and the other was long-term inflation expectations. Besides, of course, another bout of COVID waves, right? But and these were the main risks to our constructive view on growth. Unfortunately, the sudden flare up of Ukraine conflict, which is really a black swan event, if you ask me, has meant two of those three key risks have come to pass, with oil prices surging almost 50% year to date. Given the close link between oil prices and long term inflation estimates, US 10-year inflation expectations have now broken above their pre pandemic trend, and this is what has resulted in the Fed turning even more hawkish. Given these turn of events, we will need to watch the following factors to ensure our constructive view continues to hold. The first one is deterioration in any of the recession indicators. Most of the indicators are implying a low probability of a recession over the next 6 to 12 months. But we need to watch the 10 to 2-year yield curve very closely, whether it inverts anytime soon. The second one is, of course, Russian energy flows. Further Western sanctions against Russia and its energy exports, or any Russian decision to cut off supplies, is likely to fuel energy prices and inflation expectations, forcing central banks to turn more hawkish. Third is the conflict broadening beyond Ukraine's borders. For now, Steve, we see a very low probability for that because Russia would really not want to engage with the NATO at this point. And finally, supply shortages from China's lockdowns. China's lockdowns of Shanghai and Jilin and Shenzhen, which are the major auto and tech hubs, could prolong global supply bottlenecks, keeping US and European inflation higher for longer.
Okay, thanks, Rajat, for sharing your insights today. That's all we have time for. Thanks also to the listeners who are joining us today. Just as in terms of what to look forward to, so the third part of the mini-series will be on Tuesday, when Abhilash will join me to discuss how bond investors can position themselves in the coming months in the face of rising inflation and interest rates. With that, let me bid you farewell and take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.